I'm here with Dave Nichols from NBKC Bank, and Dave and I have worked together for 4 years now. So he's done a lot of loans for a lot of my clients. And today I had a couple of questions about VA assumable mortgages. So I wanted to ask you, what are some hurdles that people need to be aware of? How is an assumable loan different than a traditional just taking out a mortgage?
Okay, so an assumable loan, people are going to go after an assumable loan because it's going to offer a lower interest rate than what they can get in the market right now. And that's the only reason for going with an assumable loan. Some of the hurdles are the time frame it takes to process an assumable loan. For example, on a VA assumable loan, it goes through a different channel than what a client would come to me and get pre-approved. It goes through our servicing department. So our servicing department is the one that's going to do the approval, and then they're going to process it. And it's going to take a little bit longer. It's going to take at least 60 days if our company is doing it. And I've heard in the industry, sometimes it takes even longer. So that is usually the biggest hurdle, is you've got to have a seller that's willing to go through that process and take that extra amount of time to let you assume the loan. Now, for example, on a VA, they're going to have to qualify exactly the same as somebody who's taken out a new mortgage. So they're going to have to income qualify. They're going to have their eligibility through the VA, because that eligibility is going to go from the seller to the buyer in that situation. And so that's probably the biggest hurdle, is the time frame. Second thing is,
I was going to say, so if the person is not coming directly to you, they're going to whoever the seller's loan is already being serviced with.
That is correct.
So one thing is the buyer doesn't get to choose who the lender is. The lender is whoever already has that loan. And then you also mentioned that the buyer has to qualify, obviously. I'm assuming that they can qualify based on, like, their debt to income ratios and everything is based on that lower interest rate as well, right? So that's a potential benefit. So they could possibly afford more. What about if the home, say I have a buyer, we're looking at a $500,000 home, but the veteran has paid it down to $300,000. So they only have a loan that's assumable of $300,000. Does the buyer have to come up with the $200,000 in cash, or can they go through you and get a second mortgage, or how does that work?
Most of the time, they're going to have to come up with that money in cash. There are lenders that will put on a second mortgage, and they may only go to 90% of the value or 95% of the value using a equity product. I have heard of a couple of credit unions that will do the full 100% in 2 different loans. So it just kind of depends on the servicer. And if you get lucky enough to have one of those servicers that can do that, then yes, they can finance more.
But for the most part, the buyer is going to have to come up with at least some down payment. So one of the primary benefits of a VA loan in a normal market is that you don't have to come up with any cash as a veteran. But if you're assuming a VA loan, whatever the previous veteran has paid off compared to the sales price, somebody has to come up with that cash. So the buyer's side, the buyer has to come up with that cash, either in cash or a loan. So
or a loan or a combination of those.
Okay. How does it complicate things? Say I have a veteran buyer and they have a home to sell. Their loan may be assumable as well. How complicated would it be for them to sell their home with an assumable mortgage and buy a new home with an assumable mortgage? Are they going to need to rent in the interim, because of the lengthy timeframes? Can that be coordinated?
It's going to take longer. And if you've got your client who's selling their home and they're doing the assumable route, then that's going to take a little bit longer. And then you're going to have a longer contract on the purchase. Now, as far as their eligibility goes, once their home has been sold, then that's going to free up their eligibility to be able to purchase the other one. So, and our bank, for example, works with the VA and gets that eligibility restored right away so that they can get a new home loan and have that VA eligibility and have that loan be backed by the VA.
Okay, so a typical, not an assumption, but just if they were to get a VA loan today, they could close in what, 30 days?
Yeah,
But if they're,
I'm closing 30 days and a little bit less sometimes.
okay, and if they're getting an assumable, or if they're trying to assume some other seller's loan that's a VA loan, you're saying it's months, 2 to 3 months?
Yes.
Okay, what's happening during that time period? I mean, isn't the lender just making sure they have eligibility, making sure, you know, doing the same things you would do on a new loan? What's the holdup in that process?
Well, you're dealing with the servicing side, and it's probably not as efficient as what our part of the bank does, and that's just put loans on the books and go through and do everything. So I believe there's a little bit more verification that they have to do on the servicing side, and just to make sure that whoever's assuming that loan is going to be able to make those payments and does have eligibility. So it's probably just a little bit more cumbersome.
Okay. I interrupted you way back when you said that one of the main hurdles is the time frame is going to be longer. What are some other things that
Well, the other one we just spoke about, and that's the client having some cash to make up the difference between the purchase price and the loan amount. And that's really what all my clients have an issue with, who want to get an assumable loan, is they just don't have the cash to be able to do that.
If now if they have their own home to sell, they may have equity in the home. You know, I was going to say the good news is that most of the VA loans that are assumable that a buyer would want probably were originated right before rates got really high. So they probably haven't been paid off as much.
Yeah.
You know, so they may be, it may not be that you need a ton of cash to do it. The scenario I gave, you know, would require a lot of cash, but most, I would assume most VA loans that were taken out in, you know, 2019, 2020, 2021 have lower rates than today's rates. And, you know, those could be attractive options. Now, a VA loan from, you know, 1994 would have a 7.25% interest rate anyway, you know, so we're probably looking at that being potentially a good option. You mentioned also, though, that the buyer would need to, the process would take longer, and a seller would also have to be willing to wait for that process to go through.
Exactly.
With a VA loan, is there an appraisal on the assumption, or there is?
Oh yeah, absolutely.
So you still have, as a veteran buyer, as a veteran purchaser, the same protections about appraisals and things like that. However, that makes it risky for the seller, in that if you go 45 days into this and there is some sort of issue, the buyer basically can walk away with all their earnest money, and you're left kind of high and dry. So do you think that sellers with an assumable loan are wanting more than market value because and I guess that wouldn't really help out in the situation with an appraisal required for a VA loan?
Exactly. And I think that's what you'd run into, is just that if the appraisal comes in low, then it's back to the negotiating table, or the buyer walks, or however that transpires. So there are safeguards in place with the VA loan, and the VA appraisers do seem to require proof that the home is worth that much with the comparable sales. And we've been through that before, where it goes into a tidewater situation where the appraiser doesn't think that the home is worth that, and goes back to the realtors, and I say, need some comps, some supporting documentation of why you think it's worth that much, why it was listed for that much, why you decided to buy it for that much. And so I think that the VA does a pretty good job of protecting their veterans and active duty personnel.
Thank you. Now, on the same topic, there are assumable FHA loans as well. I know in my personal experience, a lot more clients were getting conventional loans in the last little bit when rates were really low, because the rates were either lower than FHA, and there are also additional fees, mortgage interest and things that are associated with an FHA loan that you could avoid with, or pay less of with a conventional product. But I'm assuming there are some FHA assumable mortgages out there and some sellers that may offer their home. What is that process like? Is it still a 2 to 3 month process?
Yeah, it's still got to be, the servicer has to be willing to do it, and it's going to be a longer process, just like the VA side. And I believe all the same criteria have to be met. Obviously not eligibility, but as far as the veterans eligibility. So yes, you still have to qualify debt to income ratio wise, credit wise, and to assume that loan.
Okay. Well, I know one of the things we talked about before we got on the Zoom was benefits of buying now versus waiting. We've been talking, and you see news articles every day about interest rates potentially getting lower by the end of this year, beginning of next year. We're already in the 8th month, and we haven't really seen interest rates getting any lower.
No.
My thoughts are, right now it is, in our market at least, a more level market. It's not a seller's market. Appreciation is relatively flat. We did have depreciation from June of last year till January, but since January till now, this whole year, essentially we've seen pricing holding firm and or ticking up in some zip codes. And part of that is just there are very few buyers, competing for the homes like there were, 2 years ago when interest rates were so low.
Yeah.
The benefit to the buyer, of course, is that we were going at like 15, 20% appreciation in certain areas, and that obviously is not sustainable. So they really put the brakes on that literally overnight when they hiked interest rates.
Oh, absolutely. Yeah.
And so unless you were already locked in on a property, you had to start coming to grips with higher interest rates, and that's been trending, for at least a year now.
Yes.
And I guess almost since around September, October last year.
October.
Yep. But my thoughts are, if you're going to buy a home anyway, it makes more sense to buy now than it does to buy a year from now. If rates do go up in the next year, then you bought at today's low rate, which isn't exciting today, but a year or two from now, if rates are 8%, 9%, then 6.5%, 7% sounds pretty good.
Yeah.
If rates go the other direction, the majority of buyers should still have home equity, especially because prices will probably rise if rates go down, because an influx of buyers will come into the market. But you're buying today without a lot of competition. So right now we're able to negotiate repairs. We're able to negotiate price. Homes are on the market longer. We were, 2 years ago, 3 days on the market to 7 days average. And now we're, 60 to 90, depending on the area again. So if rates go up, then you got a good rate today, which doesn't sound good today, but it will, in hindsight. And if rates go down, potential to refi to the new rate, and you're already locked in at today's pricing, and your payment would just go down. So that's
and when people do the refinance, if they put maybe 5 or 10% down, their PMI or mortgage insurance is going to be higher. When they refinance, they're going to have a little bit of appreciation there. With a new appraisal, you may get a lower PMI factor with a lower interest rate. So there's all sorts of benefit to buying now. and
Yeah.
and getting that value locked in, or that price of that home locked in.
Yeah. What would you tell a first time buyer? They've been saving for a couple years. They were about to do things and then rates went up, and prices, of course, have continued to stay kind of out of range. And especially their monthly payment has ballooned
Mm-hmm.
to, a much higher amount than they thought it was going to be. Would you tell them to just keep socking away and saving? Or again, do you think now would be a good time to get in, and as
Well,
long as they
first time
qualify,
home
of course?
buyers, yeah, if they qualify for some of these first time home buyer programs, the rates are a little bit better than a conventional 30-year fixed. Um, and uh, once again, we talk about, put as little down as you can when you're a first time home buyer, because you want to have some savings for things that come up. So if they continue to sock away some money and get to a point where they can refinance, maybe then they think about plunking down a little bit of extra money to get out of the PMI or a lower PMI factor and get a lower interest rate at that point. And it's all really goes to how strong that first time home buyer is. Do they have the capacity to do that as far as their payments go? It's still saving money, even though they're making a mortgage payment. Hopefully they do, and don't get themselves into a bad situation. And we've all seen that. I've been in lending for over 20 years, and I've seen that. So, and it's unfortunate. So, I think the biggest thing that I tell first time home buyers is you got to have some savings when you buy that home. You got to be able to get through a couple of tough months if an extra expense comes up.
Don't put every penny you have into getting the home and have nothing
Yes,
in reserve. So,
absolutely.
yeah.
Yeah.
You brought up, you didn't bring it up, but you brought to my mind the concept that I'm seeing a lot of lenders offering buy downs.
Mm-hmm.
So my understanding on a VA loan is you have to buy the whole 30-year term, or 10-year term, whatever it is. On an FHA or a conventional loan, I'm hearing about 2-1 buy downs. Do you want to explain? Those are not
Sure.
ARMs, right? Or they could
Yeah.
be, but they're not necessarily. You can get a fixed rate temporary buy down or a permanent buy down. Do you want to explain the difference between those?
You bet. A permanent buy down is basically you're paying points, and you're just buying down the rate over the life of the term of the loan. On a We offer a 2-1 buy down on conventional loans only. We don't offer it on FHA or VA because of those contracts. So on a conventional loan, a 2-1 buy down means that if today's base rate is 7% no points, and you do a 2-1 buy down, the first year the interest rate's going to be 5%. The second year it'll be 6%, and after the second year it goes back up to the 7%. Now that buy down cost is basically going to be the difference in the monthly payment for the first year, and then the difference in the monthly payment for the second year, and that's the buy down cost. We only allow that to be paid by the seller. So Fannie Mae allows for it to be paid by some by the buyer, some by a third party, but we're only allowing it for our program to be paid by the seller. So
Okay.
it's a true benefit to that client. So let's say they do a 2-1 buy down in that scenario. Today's rate 7%. Now they're in the first year, it's 5%, and rates come down. So they come down to 4.5%. They can do a refinance and refinance down to 4.5%, and whatever money is in that's left over gets applied towards the principal amount of the loan.
Really? Is that
Yeah,
just your program, or is that pretty
now
standard across the board?
that's pretty standard
Okay.
because that money is paid to supplement that interest rate.
So it really is
And
kind of like an impound account or an
yeah,
escrow account where you're subsidizing your own payment with an upfront chunk of money, but
Yes,
in your program, you're having the agent and the buyer ask the seller to front that money.
that
So,
is
so that
correct.
again, it actually is a savings. Otherwise, you could just have a buyer and say, hey, keep this much in a bank account and pull this much out every month. But
Yeah,
as a
yeah,
lender, you want to make sure that they really only have the burden of making that lower interest rate payment, and then
right.
the middle, and then the rest of the term. So,
Yes. Yep.
um, how is that different from an ARM? You know, an ARM is an adjustable rate mortgage. Um, and again, there are various types, but the most
Mhm.
common ARM you see is how many years, how much can it adjust, and how bad
It's
could
a,
that be for somebody?
yeah, it's a 5-year arm usually, and you don't get uh, as much of a benefit in the lower interest rate upfront because there's not that big of a spread between them. For example, I may have a ARM product, and instead of a 7%, it'll be 6.5%. So you're not going to see that lower amount. Now, is the payment going to stay lower for the first 5 years? Yes. But then you have a risk of it going up or a benefit of it possibly going down after that first 5 years.
So
So,
the first 5 years of a 5-1 ARM,
mhm,
5-1 means that it's fixed for 5 years.
correct.
Okay, and so because they're agreeing to that lower rate for a 5-year period, there's not that much of a
Mm,
difference in the payment.
right,
Because
right.
there's not, yeah. Okay. And then the one means
It
is
can
that
adjust every year after that.
every year?
And there is a cap, and it depends on everybody's program as far as how much it can increase or decrease that first adjustment, and then every adjustment after that.
Okay, so that would
Uh,
be loan specific in the
correct.
details of the loan that you're getting. So a
Hmm.
borrower would, the 5-1 means fixed for 5 years, and then it adjusts every 1 year after that.
Yes.
Okay,
Yep.
to whatever the terms of the contract are. So you definitely
Mhm.
want to read that. Okay. What
Absolutely.
other things are you seeing for buyers that are, not just first time buyers, but any buyers out there? What other programs, what other things are available, or what are they doing to be able to get excited about buying a home in this market?
I think it's I'm not so sure anybody's really excited about talking about interest rates. I think that the mindset nowadays has shifted from we're expecting 3%, 3.5% to all right, this is the new norm and this is what it is. And if there's an opportunity and at the end of the year or next 12 months, 18 months to refinance, then that's just a benefit. So I think everybody's kind of figured out that it is what it is. If I need a new home, I got to do it, and I've got to bite the bullet, basically.
Yeah. One other thing you talk about mindset. I think that we got really spoiled. Me too, like everybody, right?
Yeah.
Because when you could borrow money for so little, for 3% interest, historically that's way low,
Hmm.
much lower than the average. But what it allowed a lot of first time buyers to do is buy what would normally be a second or third time home purchase with,
Absolutely.
yeah. So, when I first bought my first home in my neighborhood, there were homes that were 1,500 square feet, 1,200 square feet, 1,800 square feet. They're still out there. The homes are still there, but
Yeah.
first time buy, a lot of buyers with the interest rates as low as they were, like I mentioned in 94, I bought my first home. It was 7.25%
Hmm.
interest rate. So, I mean, we're still below that, so I bought
Yeah.
a home with interest rates around, what they are today. And I did a buy down, a 2-1 buy down, by the way, back then.
Yeah.
But today with rates back at 7.25, I mean, my first home had no garage, no air conditioning, no sprinkler system, and
Yeah.
buyers in the last couple of years, 3-car garages, 5,000 square feet, all
Hmm.
this stuff because it was easy to get the money. So I think one of the other mindsets that might need to change is your first time buyer might just need to wrap their head around, I'm buying a starter home, like an actual
Yeah.
starter home, not
Yeah.
what a starter home 3 years ago was, but a starter home for all of time, like the lowest level of home ownership, and work my way in You know, as I and my
Exactly.
parents and many people, you know, you get your first piece of real estate, you let it appreciate, and then you sell that and use the
Hmm.
equity to buy into something bigger. And you know, you take
Absolutely.
advantage of refinance options when they come along and things like that. So
Yeah.
yeah, I think that mindset also, it's hard to adjust because literally overnight you could buy twice as much essentially for your monthly payment, and
Right.
you know, that's gone away. So
Yeah. You
yeah.
are absolutely correct. I was in that same boat. I think my rate was a little worse on my first home back in 96 or something like that, was I think around 8.5. But being in the industry, you know, I took advantage of it when the refinances came around, and lowered my rate and lowered my payment, and built up some value in my property before I moved on to the next one and the next one. So
Yeah, absolutely. I would like to end with, I guess, just thanking you again. You've been very helpful to many of my clients over the years. And I struggled for a couple years interviewing lenders all around the country. And I had met Dave at a conference of the National Association of Exclusive Buyer Agents. And he sounded like a good fit. And he has been. So he's been, again, low upfront costs, low interest rate. When we do loan shop, we help our clients loan shop, and usually lowest upfront cost and lowest fees combined. So usually it's one or the other.
yeah.
And also very timely, very you guys have do you still do the on-time guarantee?
Yes, we still do have on-time guarantee. It just
Tell
has
us
to,
about the on-time guarantee. How does that work?
yeah. So it's a $5,000 guarantee. Um, we do require that we have 30 days from the time that we get the contract to closing. So enough time for us to process within reason. Um, so the guarantee is $2,500 for the buyer, $2,500 for the seller, assuming that we're not closing because of us. You know, there's all sorts of factors that go into this, whether it be the buyer not providing documentation on time, repairs not getting done on time, title work not coming in or not having clear title, appraisal issues. So,
You're
excuse me.
committing that if everybody else does their part, your
Correct.
job will be done within, is it 30 days or is it whatever date you specify?
Um, as long as we have 30 days, it can be 45-day contract. It could be, but as long as we have 30 days from the date that we received the contract, so us started working on it, yes, and that's checked by my manager, and he has to say, yep, this one qualifies.
Awesome. Awesome. All right. Anything else we need to know? Oh, are you licensed in all 50 states?
I am licensed in all 50 states.
Okay. So you could help anybody anywhere in the United States.
Absolutely. Yes.
Sweet. What other products here? We talked a lot about VA loans today. You guys do a lot of VA loans.
Yeah, we
Uh,
do. That's one of
FHA,
our
conventional.
FHA conventional ARM portfolio products. We have portfolio products for clients that don't necessarily meet that conventional guideline, whether it be self-employed, bankruptcy, time from bankruptcy, um, and a few other income as assets type of scenarios. So we do have some portfolio products that we can offer. Us being a bank, if there's something that's not quite in the box for a conventional loan, I can submit it to that department that does our portfolio loans and say, hey, what do you think about this one? We got a big down payment, just they don't qualify for this guideline. And sometimes we can get those done. So having that in our back pocket is great. We do also offer piggyback loans. We do offer, the client's got to come up with 10% down, and we'll do another 10% second mortgage along with the first mortgage, whether it be a portfolio loan or a conventional loan for that piggyback scenario to keep them out of the PMI.
Okay. And you jumbo financing, I'm aware you have jumbo
Yes,
loans.
we do.
So if the loan value is higher than the conforming limit, you have products available for that.
Absolutely. Yep.
Good, good. And best thing for people to do if they have questions is just call you up and
Absolutely.
ask you.
Call me and we can run through scenarios and look at numbers and just really get to know each other and see if it's a good fit and if we can help them out.
Okay. Sounds good. Well, thanks for spending time with us today, Dave.
You bet. Thank you,
Talk
Ben.
to you later. Bye.
Bye.
For help finding a real estate professional in your area, visit RepRelocation.com.